Welcome back to the Wealth Clock with Steven Weinstock podcast, where top operators, founders, and closers share what really works. Today, I'm joined by Samuel Harnish, the founder of Quantitative Financial Strategies, or QFS for short. He's a CFA, a CFP, and holds a master's in applied quantitative finance. Before launching his own firm, he worked at powerhouse institutions like PIMCO and a prominent multifamily office. What really sets him apart is how he brought together tax-smart investing, high-level finance, and modern digital presence. He's built a brand online while at the same time staying laser-focused on long-term results for his clients. We're going to talk about what exactly tax-aware investing really means, what it's like to start a business in your 20s, and how he's used social media to fuel his growth. Samuel, thank you for joining us.
Thank you for having me. I think that was the nicest introduction I've ever received. So thank you.
My pleasure. It says you started a business in your 20s. I also started in my 20s investing and working for myself. Tell me about your early days, your early path, what drew you to finance originally?
Oh man, that's a good question. And I guess I don't totally know. I think inherently we're all have proclivities to be interested in certain things. And as far back as I can remember, it would be when my dad got the first iPhone, it had the stocks app on it. And anytime I was somewhere with my dad, I would ask if I could go on his phone and look at the stocks app and look at Apple stock and Microsoft. And it just always fascinated me from a young age. When I was playing lacrosse and being recruited looking to colleges, it's just how good was the lacrosse program and did they have a business school where I could major in finance? Those were my two criteria. And I guess that's the start. And then getting to work at PIMCO when I graduated was an unbelievable experience. I think my advice to other people would be, I don't know what your background was before you started your firm, but for me, it was so great to start my career around the smartest people in the industry. The amount of information I was able to absorb and learn, partly with what I was doing, then partly just listening. If you're around extremely intelligent people and get to listen to the conversations they're having, you really accelerate your kind of growth trajectory in your career. I'd be fascinated to hear if it was a similar experience for you or something different.
I always say try not to be the smartest guy in the room. They learn a lot better that way, although a lot of people are intimidated by smart people, the smartest guy in the room. You got me feeling a little old when you said your dad's iPhone, because when the iPhone came out, I was already an adult and I had a BlackBerry for way before that. And when I got into real estate investing, which is what I do, we're talking flip phones. And even before cameras were on the flip phone, I started in 2001. I'm 47 now. I started in 2001 buying, I meant to buy one single family home. That was my goal. I always wanted to get into real estate, not necessarily as a career, but to own it. And I bought one single family home while I still had a corporate job in advertising. And my goal was to keep just one and pay it off over 30 years. And that would be like an added or a padded retirement account, so to speak. After 2 or 3 months of collecting rent, the numbers started clicking. And why just one? Why not two? Why not five? Why not 20? And like I said, I was still a kid living at home with my parents and I had a job. But even back then, the financing on properties were a lot easier than they were today. This is before the subprime crisis. And I was able to buy properties with sometimes 10% down, 15% down, sometimes 0% down, a lot of creative financing, a lot of seller financing. But yeah, that's how I got into it. But I realized it was my career pretty early on. Yeah, I was in my 20s also.
When the
And
numbers just started to click, you had the light bulb moment. This is
yeah,
what.
it's really, you got to really be in it to understand it, because I thought I understood everything. And then as soon as I'm collecting the rent and I'm looking at my mortgage statement and I'm seeing I'm paying down equity and I'm making a few dollars on the cash flow, why not do a second one? Why not do a third one? Oh, wait, I could refinance in a couple of years and possibly pull out some of this money. It just kept getting better and better. Obviously, the property management side is a whole other side of the business, which I learned the real quick and real tough on why it's not necessarily considered passive investing for a guy like
Yeah.
me. But even I have investors in my deals who are truly LPs, meaning they're truly legally limited partners. And even them, I tell them it's not necessarily passive, meaning you could still have your job. You could still be a lawyer, your accountant, your plumber, but you have to vet me or vet the sponsor of the deal. And you have to be on top of it. You have to make sure that you're getting reports. You have to make sure he's performing or the deal is performing. So it's not just set it and forget it. It's, you don't have to necessarily pick up any tools. You don't necessarily have to cancel a vacation because of it from the investment side. I wouldn't say it's just sleep on it like a treasury bond or something like that.
I could definitely speak to that with my time at the multifamily office. That was my full-time job, was what you're describing, the manager due diligence of these different private investments that wealthy families will be doing. If they don't have someone doing that for them, like people that would come into the firm and like your first time looking at it, it was just all over the place, unorganized mess, and it can happen pretty quickly. So I completely agree with what you're saying, that it's not all passive from an investor standpoint.
So we're going to have a lot of people who are watching this who are in the real estate business. I just want to delve into, you mentioned you worked for a family office. They own some multifamily. Without giving too many private details, what can you tell us about that? Where were they investing? What kinds of properties? And just tell us a little about that.
Sure. I think there's just so much jargon in the industry. Sometimes there's confusion. In my world of like wealth management, you've got the independents. They're called RIAs, and they're just where your independent financial advisor will work, and they'll do financial planning and investment planning, manage all of that for individuals and families. When the net worth of the clients you're working with starts moving up higher, you move from the RIA space into what is called the multifamily space. And where that comes from is families that have, let's say, a few $100 million, they'll actually make something called a family office, where in-house, internally, they set up their own structure to do the investment management and financial planning. Maybe there's some estate and tax components to it. Instead of working with a third party or a firm, they make it on their own. Now, if a family doesn't have that kind of wealth, let's say they have just $100 million, it's not really enough to hire a team in-house. The economics just don't make sense. But what you can do is you can work with a multifamily office, which essentially tries to provide the same service as a single family office, but you're able to do it by pooling the resources of multiple families together. And so that's what I was working at, is a multifamily office that was definitely more focused on the investment side. And so I spent all of my time on the research team looking at mostly private equity and hedge fund managers were the big two alternatives that they look to add to client portfolios. So that's what that was about.
Got it. Yeah, no, in the real estate world, multifamily, it means you're buying apartment buildings or 5 units plus. That pews me a little. So you're dealing with offices, family offices with a low net worth of only $100 million.
Yeah.
And since they're not,
I know, isn't that awful to say?
Since they're not rich enough to have a dedicated team, they get lumped together. 3 or 4 of them will try to save on some costs or make it worth it economically, where they'll have a team that's dealing with multi families who have a family office.
Yeah, it's essentially, excuse me, a shared family office. And so it's multi, meaning multiple families.
Got it.
In one sort of business wealth management firm.
Interesting. So I raise money from investors for the real estate assets that we buy. I've spoken to family offices over time, and some of the family offices I speak to could have a net worth of 20 or 30 million or 50 million. So they typically won't have a dedicated team that is deploying their capital, but they'll have one of the family members who is the point person to deal with any incoming opportunities that come through. And then from there, I guess they discuss it and they figure it out. But that's very interesting how family offices are really like their own business just to deploy capital. And I guess they're mostly about really preserving their wealth. Guys who are starting out, it's all about even big risks and how could I double and triple my net worth real fast. And when you get to a certain level, you want to preserve it. And it's not necessarily just keep it. You want to beat inflation at least. And you're fine making the 8 or 9% a year sometimes, where a guy like me, I don't want 8 or 9% a year. I want more. For 8 or 9%, I guess I could stick it in SPY or QQQ. And for the most part, that's pretty passive. Just write it out and I won't have any cash flow. But when you're worth 300 million, that 8 or 9% is a much bigger deal. You mentioned, or I've seen in your profile, tax aware investing. Sounds like a buzzword. I hate paying taxes. I hate it with a passion.
But you're in the right industry then, being in real estate.
I love being in real estate and have many options to defer. I'm a big refi till you die type of guy. Tell me about tax aware investing. I guess break it down for my listeners.
Yeah, I should come up with a different tagline if it is too much of a buzzword, but really all it means is investing tax efficiently, which sounds super obvious. And to people outside the industry, they probably look at that and they go, duh, we all know that we should be investing tax efficiently. Yet when you look at how people are doing it in the industry, we do not do a good job at looking at investments through an after-tax lens. Your pre-tax return, your pre-tax IRR, your pre-tax multiple on your invested capital, that means nothing. The only thing that matters as taxable investors is what you keep. So I'll see investments that are high octane income hedge fund where there's a lot of trading going on strategies, and you'll go, this is amazing. You were just describing people want to see something that beats the S&P 500. What if I'm able to do a 15% return, but it's all in the form of ordinary income, which the people I work with, they're getting taxed close to 50% on that. And suddenly their 15% return, maybe it looks more like 7 or 8% after taxes. You would be better off in a tax efficient 8 to 9% return. So that's what tax-aware investing is all about, is how do we level set all the investments we're looking at and just look at things through an after-tax return perspective.
So just to pivot back, when I said buzzword, it wasn't a negative. It's a good thing and it sticks. Tax aware investing is definitely something that more people should look into. I think you have a lot of people out there that don't make enough where they're constantly thinking about taxes. When you reach a certain level, you really care about this money that you're giving to Uncle Sam. And it doesn't matter what side of the aisle you're on. You could spend your money better than Uncle Sam for the most part. And a lot of it gets wasted and abused. I think people would be happier paying taxes if it got spent really well.
Yeah, the Doge findings didn't really help
Exactly.
feeling about that.
Exactly. But I guess I'll ask this. What type of investors benefit most from this strategy?
Yes, obviously, if we're talking about taxes, it's those that are in disproportionately large, higher tax brackets. So you got your high income earners, they're being pushed up into high income tax brackets, but then you've also got people with just large portfolios. If you're not careful with a $10, $20 million portfolio, you're going to push yourself up into higher tax brackets just based on how you're invested. The yields on some of these private credit strategies, I'm sure you're aware of, they're double digits. And people just become so enamored by that and they don't look at the taxes. But yeah, that's who it ends up usually being, is people that are either high earners or have already accumulated a significant amount of wealth, because that's when taxes really come to the forefront.
Any common mistakes investors making when it comes to taxes and investing?
Yeah, I guess like some of the easiest ones are, everyone has some sort of cash reserve, right? Like you call it an emergency fund or some sort of liquidity sleeve that you have. Maybe it's to fund deals that you're doing yourself. A lot of people don't seem to realize a high yield savings account, like at a bank, that's taxed at both state and federal. Whereas treasury bills are exempt from state taxes. So like for most of my clients that are in California, that can be meaningful. If the top state tax bracket in California is 13.3%, that small decision of, hey, we want to make sure our emergency fund is allocated strictly to T-bills so we get this tax treatment. I think that's a big one. Another one is tax loss harvesting. And pretty much everyone knows when you make money on an investment, you owe taxes. That's just the way it worked. But not everyone seems to know when you lose money on an investment, the inverse is actually true as well. If I sell or get rid of an investment that's lost value, I create this sort of tax asset this loss I get to use to offset any gains that I have elsewhere. And so it's something that we see. But if we go back to April, you brought up QQQ. If someone had invested in QQQ this year, in April, I think it had dropped over 20% at one point. That is a huge opportunity to sell that position and buy something similar. And by doing that switch, you capture this loss that you can then use to offset gains that you have elsewhere. And I think what not a lot of people are aware of is this new way of doing it that kind of enhances it is when you go long and short stocks. So that's one of the biggest strategies that I do for people that have big liquidity events or capital gains, or they don't want to 1031 one of their properties. They're like, hey, I'm ready to actually punch out of one of my properties and I want to take the gain and I want the capital. What you can do is you can open a long short tax loss harvesting account. And that way, no matter which way the market moves, you're losing money on either side. As the market moves up, the shorts are losing value. As the market moves down, the longs are losing value. And the volume of capital losses that you can harvest with these strategies are much bigger than in a long only portfolio. And they're fantastic for people with the liquidity events that we're mentioning. Part of the reason of starting my firm was selfishly for my own family. We have a multi-generational family business that'll likely be sold in the next 10 years. Part of that business is an industrial property in Southern California where the embedded gain is massive. I'm sure you're aware of in these pockets where they're just not able to make new warehouses. They're well located. And like, for example, he manufactures overseas, gets his product distributed, comes in through Long Beach in the port, and then it's just an easy straight shot to Huntington Beach where the warehouse is at. The value of something like that is incredible. But it also creates this significant tax burden when you're ready to sell and be done and retire. And California's the worst when it comes to taxes. They don't look at income and long-term capital gains as two different things. Like, people are just assume, oh, it's long-term capital gains. It's a great tax rate. If you're in California, it's over 30% all in. It's awful. So anyways, that's one strategy that's pretty great and one that I'm using for my family just in preparation for our liquidity event.
As soon as you mentioned California and an asset that's multi-generations, yeah, it definitely went up in value 20 times or whatever it was. And you'll have a nice tax bill. So whatever you could do to save that should be beneficial to you and all your close siblings and cousins, etc. I've seen you on social media. I've seen your presence on LinkedIn where I'm pretty active. When did you get serious about being on social media and creating content and being out there and getting yourself out there?
I'd say maybe 5 or 6 months ago, I started my firm and I had friends and family that wanted to work with me and initially just started with my own network. And that runs out pretty quickly.
Yeah.
Like your own network. And then I was thinking, what can I do? And then I said, oh, social media. Like, why not? You can make videos, you can write posts, just see, I don't know. I just wanted to test it out and see how it goes. And the feedback was overwhelming. There's some weeks where I've added like 1,000 followers across my different accounts on the different platforms. And it's become really fun. I've learned a lot from other people. I get to meet people like you and just exchange and share ideas. And it's been amazing. So yeah, 5 or 6 months ago is when I started getting active, and I don't miss a day where I don't post on LinkedIn. It's something that like I'm very deliberate about, and I kind of schedule, these are the posts I want to write about, and it's just built into part of my work schedule.
I increased my network. I used to raise money from family and friends for some of my real estate deals, and that runs out also pretty fast. And I would be very adamant about trying to get referrals. Get me your friends, get me your cousins. Just get me on the phone with them. You don't have to sell. I'll do the pitch. And after a while, even that is exhausting. When I say exhausting, I don't mean I got tired. It's just you run out of that real fast. And I also made it my mission to expand my network. I started speaking at real estate conferences a lot for the past year or two. Just came back. I was in Florida last year talking, where I was part of a panel on the stage over there. And that really helped with my network. I've been also active on LinkedIn. I haven't really played around with Instagram, although my kids tell me they don't know they don't even know what LinkedIn is, but they tell me Instagram. So I have to get a little more deliberate with that. But I've definitely increased my network a little on LinkedIn. I'm hoping with this podcast, I should also increase my network. And the main reason for the podcast is I want to speak to interesting people. And sometimes I can call somebody up or I meet them at a conference and they might give me 2 minutes of their time. But if I tell them, hey, I'd like to interview you on a podcast, they'll say, sure.
Yeah.
And
Yeah.
just the last couple of days, I did some interviews we pre recorded. And I spoke to some real powerhouse people that might never give me the time of day otherwise.
Built into it is it's flattering, right? When someone asks, "Hey, will you be on my podcast?" And then someone's, "Yeah, I get to talk about myself for 30 minutes. I'll do that."
Yeah, exactly. So I've been on some podcasts over the past 12, 18 months, and it was flattering. Like you said, people would reach out to me and say, hey, do you want to be on the podcast? And I would say, yeah, sure. And I'd show my wife the email. Hey, look at this. I'm coming home and you're telling me to take out the garbage. I'm going to be on this guy's podcast. I
Yeah.
mean, what are you talking about? So it's definitely flattering and it helps. It increases my network. I get to promote it. The episode comes out. They gave me some links. They give me some artwork. They give me some YouTube shorts and TikToks. You send it out to the guests. They promote it. So it's definitely a fun idea. So you're in the finance field. Do you think every finance professional should be building an audience, or is it just for certain personalities?
Yeah, it depends where you are in your career. If you talk to the average age of a financial advisor is, I think, around 55. There's a large proportion of advisors that are in their 60s. Do they need a presence on social media? No, I don't think so. I think they're doing just fine and they've got their big book of business. And frankly, their crowd, I don't think is on social media quite as much as maybe the younger demographics.
I think the crowd of social media is tapped out, meaning I know these days you say the word Facebook and it means, oh, my grandparents. And you say the
Yeah.
word TikTok, it means my kids. And LinkedIn could be 40 and below on business people. I get sometimes I'll get an email or someone gives me their email address and it would be at AOL.com. And I know without a doubt, this guy or person is over 55 years old, without
Yeah.
a doubt. And then sometimes I'll see the Hotmail and the Yahoo Mail and it means a different age bracket. For some reason, Gmail is all encompassing, and then I guess iCloud, etc. But yeah, it's hard to gauge because could have a 60-year-old guy who's got a big book of business on being a financial planner or anything, and he could morph into an online personality and
Yeah.
he could increase his business. But yeah, it's definitely targeted to the young. In fact, young people, they don't want to see the business card. They want to see, they're searching for the guy online and seeing what kind of videos he has out there. I go to his conferences all the time. And if the person is older, they're going to ask me for my business card. And if they're younger, they're going to ask me for a QR code so they can scan it right into their phone. Yeah. So even when people give me a business card, I take a picture of it and I hand it back to them because I don't need the card. I really just want it in my device.
I would say for me, you can hit the different demographics on the different kinds of platforms. If you're making videos or text posts, nothing stops you from posting, like cross posting them on all the different sites.
Platforms.
I would say for me, I read a book that was called The Visual Sale, and it really convinced me that nothing builds trust because anyone in the finance space, it's all about trust. If someone's going to give you capital to do in your deals, like at the end of the day, they have to like you and trust you to do that.
Definitely. And just to cut you off a second, when I pitch a deal to my investors, a real estate deal, they'll look at it. They're looking at numbers. They're looking at pro formas. They'll say, oh, I like investing in Texas or I like Ohio. But in reality, they're investing in me. It's really just about me. For the most part, sometimes they're not sophisticated enough to know about the deal.
Yeah.
And they might just be asking questions to make themselves feel better.
Yeah.
But really, they're investing in me and they have to trust me. They have to vet me because they're LPs, they're limited partners. And their job stops as soon as they write the check. They could be on top of me and ask me questions. But for the most part, they have to invest in me. So it doesn't matter if I'm investing in a market they don't like, they have to like the sponsor. So it's exactly what you said.
And I was just going to say that psychologically, a video neurochemically works completely different than if I were to read a text post. So my advice to people would be try to make more video content. It's just so much more engaging and has the ability to create that trust in a way that text posts can't. So I was reading that book and they're going through some of the stats of how much time people spend on their phones and how much time people spend consuming videos. And now it's much more common to see short form videos. And
Yeah.
then while I'm reading it, I felt so oblivious before this. I actually start looking around. Do you ever go to like a gym or something?
Not as often as I should, but yes, there.
You have. So
Yeah, sure.
time you go, look around and count how many of these in between sets while they're rolling out, while they're stretching, faces glued to phones. It's unbelievable. So I put those two together and was like, wait, like if you want to grow a business, it's silly not to make content because that's what people are doing like all day is they're just glued to their phones. That was when like the light bulb went off for me. It was like, I should go all in on making a lot more content.
Yeah, yeah, it's definitely the way to go. When I growing up, it was all about the living room and whatever content worked in the living room. I remember like in the late '90s, Microsoft invested in, I think it was called Web TV. I forgot exactly what it was called, but somehow to marry the computer to the living room, and they would give you a keyboard. It never really worked because people weren't going to sit there and type or Yahoo search into a TV screen. But I guess over the years with phones and different tech, the short form really works because people, like you said, they're in between sets. They're waiting for the subway. They're just waiting for their food to come at a fast food place, and they'll donate 3 minutes to watching
Yeah.
something. And I find myself even watching regular TV shows, like a regular whatever CBS show. It takes me like 5 days to watch it because I'm watching it like in 2 minute increments. And I'm stopping because life starts. And now I wish I was more into the short form because it'd just be easier. I keep having to go back to the app. It loads. It's back on a commercial. So that's just me
Yeah.
personally, but it'll take me like days to watch like this 30-minute or 40-minute episode. It's just so
Yeah.
interesting.
There
Yeah.
is an interesting bifurcation between ultra short form and then your Joe Rogan 2 to 3 hour podcast. It's fascinating.
Yeah.
People seem to be interested in both.
Yeah. And also with podcasts, you'll have a lot of people check out a podcast and they're looking at the person's YouTube channel and they'll see very little views. But then again, a podcast is played mostly audio. Most podcasts are in audio. So it's not even on YouTube. It's on Apple Podcasts or Spotify or all the others. So that the person doesn't really see the full reach, the potential reach of. I have a friend who has a very popular podcast, and he tells me this bothers him all the time that his YouTube numbers are low and that those are public. People look, oh, how many views did this video get? But his audio streams are played on 10 different networks, Spotify, Castbox, he was telling me, Stitcher, and I don't know, all these others. And they don't necessarily tell you how many streams each one was, or at least doesn't tell the audience. So it's hard for him to show off how popular he is, which is interesting.
It seems to be part of the network effect is more viewership begets more viewership, and this sort of FOMO thing of this is the popular trending podcast or YouTube account. I need to follow that and listen to that.
I use a lot of WhatsApp, and WhatsApp, a lot of videos get sent around onto groups and the different chats and all that. And there's no way for the creator to see how many people are viewing it because it's just the actual media, the file, the MP4 that's getting transferred around. And you could have thousands of people watching it and the creator doesn't even know about it because there's no way to track it. Yeah. And in my community or in my network, WhatsApp is very big. And there's WhatsApp status and all that type of stuff, which have become very popular, but there's no way to track it. People put it out there, but there's no way for them to know if people are watching it or not.
What's WhatsApp status?
So WhatsApp you're familiar with WhatsApp?
Sure. I think I originally got that years ago because it was great for international communication.
Yeah, so it just became very popular, at least in my group, because there's groups and then there's individual chats. But the status is basically you're putting out like a post. It could be video, audio, text, and only whoever has you saved in their phone and you have saved in your phone could see it. So it's not that it's private, but it's only for literally I have to have you saved in my phone, and you have to have me saved in your phone, and then you could see my status on my post.
Do you
And
get a notification when someone posts something or no?
no, but there's like a section on the WhatsApp to see. It's called the status or updates. So they play around,
It's like an Instagram story.
and it's owned by WhatsApp is owned by Facebook or by Meta, so it's part of their network. But yeah, it became very popular. It also only shows up for 24 hours. So if you post something on your status, I got 24 hours to see it, and that's it. So it doesn't stay forever. It's not shareable. I guess I could take a screenshot, but I can't like forward the video to somebody else easily.
Yeah.
So
This kind of reminds me of the streaming wars. Like I remember years ago, everyone assumed that all the different streamers would consolidate into
right.
one. And it just didn't happen. Like people started making their own original content. And here you are with WhatsApp. I had no idea people were using features like that on WhatsApp that already exist on Facebook and Instagram. And people just have their own interface
It's
that they want.
bringing you right. It's bringing whatever people want to use. Meaning, I like to use WhatsApp, so I'm going to see the WhatsApp content. I
Yeah.
happen not to be on Instagram, so I'm not seeing it
Yeah.
that much. There are people who are on every network, so to speak, every platform. So
Right.
they'll post on WhatsApp, so guys like me can see it. I'm sure I'm not the only one. I think it's more international, like you said, but somehow I don't know. In my pocket of Brooklyn, New York, it became very popular.
Okay. Good to
Became
know.
big, yeah, yeah. WhatsApp is big. Yeah, to play around with it on your phone. I'm sure you'll see. This was a lot of fun. I had fun with this. Sometimes it's nice not to just talk real estate and cap rates all the time. And I love talking to new people. I'm very passionate about trying to defer paying taxes. And I like the fact that you're an expert in the field and you're young. And it's nice. Good to see young people out there who are passionate about more than just their PS4 or PS5 or whatever it is that you kids are playing with these days. So
Yeah.
that's nice. I'm going to ask you a few more questions before we go, if you have time. What's your biggest challenge to gain the trust of a client being as young as you are?
So in my naive young mind, I've read a gazillion books about investing and about economics and all these things. And I thought, well, surely if I can quote what the S&P 500 did in the global financial crisis and the dot-com, but like I thought, what difference does it make whether you lived through it or if I can just spit out all the numbers? There is a difference between knowledge and wisdom can only come with experience. That is a shortfall of mine, is this ability to empathize with people, because that's part of the job of being a financial advisor. It's not what are the numbers when your portfolio, when the S&P 500 is down 50%, and I can quote you, we're diversified and we're invested in this, that, and the other, and so we're likely going to be down less. That's not the point. The point is, what did it feel like? What did it feel like when you lived through the global financial crisis and any assets you had got cut in half and you got laid off from work? And those are things that unfortunately I can't manufacture that. All I can do is meet people where they're at and tell them how I will prepare or build portfolios or their financial plan to weather storms that will come in the future. But it's a very real thing in your 20s when you're starting a business, particularly in this field, that's difficult to overcome. I'd love to hear what your experience was in your 20s when you're starting to fundraise, if you ran into the same things.
So I personally, for most of my real estate career, I was not raising funds. I was really just like an owner operator, doing everything myself. I would say like I said, I started about 20 in 2001. I was in my young 20s. And for the first 10 years, I was just buying these smaller assets, meaning one family to four family houses. And I was just buying them on my own. I wasn't raising money. There was a lot of leverage out there from the banks, especially until '08. And I didn't need anybody. In fact, I didn't even speak to other people about it because I don't know. I thought I have the special sauce. It's all about me and I don't really need anybody else. It's only really when I started getting into larger projects, when I started buying 100 unit plus types of buildings where it's far from just me. It's really a team. You need a guy, you need a partner who's great at property management. You need a partner who's great at handling the back end of the books, so to speak. You need a partner that's great at dealing with investors, investor relations, dealing with the banks. It's such a different, it's so different. Just the insurance part of the business is so tough and annoying when it comes to these larger properties. When I was buying 3 units, a 3-family house, the insurance was a breeze. You make a phone call. Sometimes they need a picture. Sometimes they do an inspection, but you got insured within 10 minutes. They send you the rider, the bank is good, and you're done. And with these larger properties, it just becomes like a nightmare all year long. It takes days and days just to get approved. And then they're coming down to do an inspection, and they're just, I don't want to say blindly, but they're telling you, fix this, fix that, fix this, fix that. And these are, some of them are real and legitimate, but some of them are items that I would have never thought about fixing. For example, just something I'm dealing with is repaving a parking lot. My plan was never, ever to repave the parking lot, but the insurance company wants me to. Not because of the trip hazard, because it's not that it's not cracked in that way, but insurance companies have their own actuaries and they have their own formulas, and it's all about minimizing their exposure. So if they could get a property owner to spend, I don't know, $25,000 on X, there's a 0.5% chance less that will be called in for a claim. And even though the claim could be totally related to a roof, it's just, they have their numbers and it's all about the Excel file. I'm personally more of a boots on the ground type of investor. I go down there. Like I said, I used to do everything on my own. Could I change a boiler today? No. But could I watch a plumber changing the boiler and know if he's doing something wrong? Very possible. There's a lot of nuance in the larger properties where it's about partners and getting a good team. But when you're doing the smaller properties, you can do it on your own. And there's no wrong way, right way to invest. I did very well with the smaller properties. I did very well with the larger properties. And I'm still buying smaller properties and I'm still buying larger ones. It's just like a different business. The smaller ones I do myself. I don't need really investors for it. The larger ones I'm doing with the teams, and I have partners that I'm married to and partners that I'm deal by deal. Yeah, it's just a different aspect of the business. How do you structure your day or your week to stay focused?
I'm a big proponent of having a calendar, and everything goes on the calendar. And I'm laughing because my girlfriend understands that literally, like, dates, they go on the calendar. I have too much going on that if someone says something to me or asks to do something and it doesn't get on my calendar, there's a good chance I am going to miss it. So that's my thing. And I would say being very intentional about what we're talking about here is social media. You can't just at the back of your mind, when you get a second or you get inspiration, oh, I'm going to write a post. No, if you're serious about this, there should be time blocked out on your calendar. You say, hey, for this 1 hour, I'm going to focus on drafting LinkedIn posts. Or part of that might be researching other trending posts or people. Oh, I really liked what this person did here, or what they said there. And I guess going on this tangent, what I found that works for me is you might be on a walk, you might be at dinner with friends, you might be at the gym, and out of nowhere, an idea comes. Always write it down. So for me, I have on the notes app on my phone, I'm writing down ideas as they come. If I see a post I really like, or there was a couple sentences on it that really resonated with me, I hit the save button on LinkedIn. And basically I just accumulate these aha moments, ideas. And then when it comes to my 1 hour of dedicated content time, I'm going to pull those out. And that's when I'm really going to focus and make my own. I'm a big proponent of just general organization with a calendar, and then second, specifically with content, dedicating time to it.
So it sounds, and I do this myself, but it sounds like you do it as well. You'll prepare 5, 10 posts or more, and I guess schedule the release if it's not too time sensitive.
Yeah, batching.
Okay.
It's far more efficient.
Yeah. So I do that as well. Just a quick question. When you schedule it, I'm really asking this for myself as well, but everybody listening, when you schedule the post, do you pick a certain time of the day or a certain day of the week that you feel is better? I'll tell you what I do. I live in New York, so I'm Eastern time. I started picking 7 a.m. as the time to have the post go out. I try to do Monday through Thursday. If I'm only doing 1 or 2, it'll be just randomly one of those 4 days. If it's a week where I plan on doing more, I'll do Friday as well. I'll do Monday, Tuesday, Wednesday, Thursday. Once in a while, I'll do Sunday. I haven't figured out if Sunday is a good day or a bad day yet, but I'm really liking the 7 a.m. part. Just curious what you're doing or what you think is best or
Yeah. I'm same as you. I do 7 a.m., but that's more just because it's convenient for me. Like I'm usually up around 5 a.m. and I get to go to the gym and then I'm back and ready to post things. But the biggest feedback or advice I've gotten is that these social media platforms, it's much more about consistency than it is a particular time of day or day of the week. I think it's more important that you find or pick something that works well for you that you'll actually be able to keep up, because it seems like a lot of people like the idea of doing content and they'll do it for a couple weeks, a month, and then they burn out. I wouldn't stress too much about time of day or things like that. It's just more about what works for your schedule and what can you actually be consistent with.
okay. Samuel, this was a solid interview. You brought a lot of clarity to some complex ideas, and you gave a real world look at what it takes to build something credible from the ground up. You're young. That's great. And if everybody in their 20s was doing things that you are, the country would be a lot better off. For everyone listening, go check out Samuel's content. It's going to be in the notes, his LinkedIn, his Instagram, his, what else we got? We have YouTube. He's always dropping valuable tidbits on tax strategy and wealth building. If you're enjoying these episodes, don't forget to subscribe and share the Peak Performer podcasts. Until the next time, keep learning, keep executing, and keep pushing your next peak. Sam, it was great to have you. Thank you very much.
And likewise, thanks so much for having me.